Hello and welcome. This is Islam Ahmad. I will be your lecturer today. Please read and review the risk warning. Today we'll be speaking about bonds, understanding bonds. So first of all, what is bond? What are the bonds? So a bond is very simply a loan. So a company or a government that needs to raise money to finance an investment could borrow money from its bank, or alternatively it could issue a bond to raise the funds it needs by borrowing from the investing public. So a bond is a debt security. In other words, a security that represents a loan made to third party. So when an investor buys a bond, when it's first issued, they are lending money to a government or a corporation or other entity. Mainly it's a government, okay? So this known as the issuer. In return, the issuer promises to pay a specified rate of interest or return during the life of the bond, and to repay the principal on a specific maturity date. We will now discuss this identification of the bonds. First of all, we need to understand what issue means. Bond can be issued using different methods. So bond issuance varies depending on whether the issuer is a government or a company. Mainly today we'll be speaking about government, okay? Because government are some of the largest borrowers in the world and have their own agencies that deal with issuing bonds. And of course, this would be more secure, safe to be invested in other than a company. So companies issue bonds infrequently and so require the specialty services of corporate finance firm. So when a bond first issued, it's described as being issued in the primary market. We say primary market to distinguish this from later sales and purchase in the secondary market or the stock exchange. So bonds will be issued at the price of usually expressed on amount per 100 nominal of stock. So this can be bar, which simply means that $100 of stocks is issued at a price of $100, or it can be at a discount or a premium to bar. For example, we have the US 2% Treasury bond 2041. This was issued by the US government in November 2021 at an average price of approximately $98.94, which means that an investor who subscribed for example, let's say $10,000 nominal of the bond, he will only pay $9,894. Okay, so this is a discount. So note that the convention in bond market is that prices are quoted per $100 nominal of bond. So we are giving this example from the US bond market because this is the most liquid and the largest bond market in the world. So we need now to identify what we call the nominal price. This is the amount of stock purchased and should not be confused with the amount invested or the cost of purchase. This is the amount on which interest will be paid and the amount that will eventually be prepaid. We also call this par price or face price or principal value of the bond. So if we get back to our example, the nominal amount the investor subscribed and paid for is $10,000 and should not be confused with the amount they paid to acquire it or its current market value. So now we know that there is a price, a nominal price, and we have the market value. Something else with the bond we call the coupon. The coupon, most bonds are issued with predetermined fixed rate of interest. We call this the bond's coupon. So this can be expressed either in nominal terms or in case of inflation-linked bonds, the ILBS, in real terms. So it may be paid annually, it may be paid semi-annually or quarterly. However, some bonds are issued with variable of floating coupons, while others are issued without any coupons at all. We call this the ZCB. So zero coupon bonds. So in our example, the coupon is 2% and is the bond issued by the US government. The coupon is paid in 2 equal installments. So at issue of the bond, the issuer will set out when the interest payment are be made. In this case, the interest payment will be made on 5th of May and 15th of November of each year. Okay, the amount received by the investor is calculated by multiplying the nominal amount of the coupon and then, for example, dividing it into equal parts. If it's paid half yearly, so twice it will be paid, so we divide this by 2. So our investor acquired 10,000 of nominal of the treasury bond, and so he will receive $200 of interest, which will be paid 2 equal half yearly. So the yearly payment will be $100 on May and $100 on November. So we have also the redemption date. This is the date which the issue expires, and the borrower will repay the lender the sum borrowed. So the redemption date is also known as the maturity date. So this will be a repayment. The issuer will repay the nominal amount of the bond. In this case, it was $10,000. Okay. Remember that the investor actually paid less amount because there was discount. But when the issuer will repay him, he will pay the full amount, or what we call the nominal amount of the bond. So although most bonds have a fixed redemption date, occasionally some are dual dated bonds. In this case, they have 2 redemption dates between which the bond is redeemed by the issuer, whilst others are irredeemable, meaning they have no fixed date when they must be repaid. Also, we have something called the market value. So the feature that distinguishes a bond from most loans is that a bond is tradable. Okay, so an investor who subscribe at issue can sell it later at any time before the stock matures. So the price of a bond in the secondary market depend on demand and supply, and is heavily influenced by the current level of interest rate and the time to maturity, amongst other factors. So the market value is the current price multiplied by the nominal value of the stock held. Or for example, interest rates have risen since the bond was issued, and the price of the bond was around 78.12. So the market value of the investor holding is 7,812. So that point at the time, the investor was sitting on a loss of $2,082 because of the acquisition cost, 9,884, and the current value, 7,812. So we will speak more about bonds in the United States. At any moment, if you have any issue, if you have any question, feel free to send me on the chat. And also, if you have a currency pair or something you want to ask about trading, about signals, just send me, and at the end I will be making time for that, for live trading. Okay, let's move on. So bonds in the USA, the United States has one of the largest and most liquid bond market in the world. So I will tell you now some of the bond types available in the United States. So we have something, first we call it treasury bonds. This is the first thing we'll speak about. Treasury bonds issued by the US Department of the Treasury. These are long-term securities with maturities ranging from 20 to 30 years. So they are considered very safe investment as they are backed by the full faith and credit of the US government. So if, for example, if you you bought one of these bonds, you will be having the date predetermined 20 to 30 years. And then you will be getting back your money. And of course, there will be coupons during this time. Something else we call the treasury notes. They are medium-term securities. You will notice that the difference is in the timing of the maturities, how much time this bond will take until maturity date. So the treasury notes, you remember that treasury bonds, it's 20 to 30 years, okay? Now, treasury notes, the medium-term securities with maturities ranging from 2 years up to 10 years. So they pay interest every 6 months and are also backed by the US government. Okay, this is the same, but it has less time to maturity. We have the treasury bills. This is a short-term securities, the maturities of 1 year or less. So they are sold at discount and mature at a face value. So you buy at a discount, and when you get your repayment, you get the repayment at the face value or the nominal amount. So with the difference representing the interest earned. So if you buy, for example, the 10,000 bonds, you will only pay like 9,800. So this 200 is your interest. So treasury inflation protected securities, this is the principal value of the bond is repaid at maturity and is adjusted based on movement in the CPI, the Consumer Price Index, to account for the impact of inflation. So similarly, interest payments are paid half yearly and adjusted for inflation. So this means this bond exactly made to protect your investment against inflation. So if the inflation increased, the repayment will increase actually. How we will notice, how the US government will know this? They will know by the CPI, by the Consumer Price Index, which will get a basket of goods and services and will calculate the prices, the change of prices, and within this time period, like 6 months or 1 year, the calculation will give the inflation rate, which is, for example, like 2%. So you will have 2% of interest repaid. Let's move on. Now, we of course we have bonds in other countries, but today only we'll have so little time, so we'll only speak about the US bonds. Let's speak about the risk involved with trading bonds or buying bonds. So the main risk associated with holding either government or corporate bonds are as the following. We have the default risk. This means the risk that the interest payment and the repayment of the bond may not be made. We call this the default risk. We also have the market risk, or we also call it the price risk. That's mean the movement in interest rate have significant impact on the value of bond we hold. Also, we have the unanticipated inflation risk. So the risk of inflation rising unexpectedly and its effect on the real value of the bond coupon payment and redemption payment. Because a $10,000 may not be the same $10,000 after like 20 years or 10 years. I mean the purchase power, the value of money, the true value of money might decrease because of the inflation. So we have this also as a risk. We have also a liquidity risk where bonds are not easily or regularly traded and can therefore be difficult to realize at a short notice or can suffer wider than average dealing spread. This is what we call the liquidity risk. Also, we have the exchange rate risk. So where bond denominated in a currency different to the investor's home currency, and so are potentially subject to adverse exchange rate movements. There are few further risks attached to holding corporate bonds, notably by the following. Also, we have the early redemption risk and the seniority risk. So the early redemption risk, the risk that the issuer may invoke a call provision if the bond is callable. This is only for corporate bonds, and of course the risk attached to the seniority, which corporate debt is ranked in the event of the issuer liquidation. Of these risks, market risk and default risk are the principal concern to bond investors. So let's speak about market risk. Although bonds are generally less risky than equities, their prices are intrinsically linked to the general level of interest rates and expectation of future change. Change in interest rate and yield will therefore affect the price of the bonds and bring out the risk of volatility in bond prices. So the price or market risk is of particular concern to bondholders who are open to the effect of movement in general interest rate, which can have a significant impact on the value of their holding. This is best explained by two simple examples. At any moment, if you have any issue, if you can't hear my voice, if you have any question, feel free to send me. So we will have the interest rate around 5%, the government issue bond with a coupon rate of 5% interest. 3 months later, interest rate have doubled to 10%. Okay, well, of course, we are giving like very extreme example just to show you. So what will happen in this case to the value of the bond? The value of the bond will fall. Its 5% interest is no longer attractive, so its resale price will fall to make the return offered more competitive. So if interest rates are approximately 5% and the government issue bond with a coupon rate of 5% interest, and the interest rate generally fall to 2.5%, what will happen to the value of the bond? Yes, exactly. The value of the bond will rise. Its 5% is very attractive right now, so its resale price will rise to compensate and make the return it offers more realistic. This is what we call the market risk. So, as the example, we illustrate there is inverse relationship between interest rate and bond price. So if interest rate increase, the bond price will decrease. If the interest rate decrease, the bond price will increase. As long as the interest being paid on the government bond is near to the interest rate available on the market, there is a little risk that the resale value will be different from the purchase price. In other words, the government bond has price risk or market risk only when the coupon rate or interest rate differs markedly from the market rates. Longer dated bonds are generally more sensitive to interest rate change than short dated bonds because holders are exposed to risk for a longer period. Lower coupon bonds are generally more sensitive than higher coupon bonds. We have something that we call the yield value. The link between maturity and yield can be seen by comparing the yield available on similar securities of different maturities from shortest to longest, and usually refer to the yield curve. So as you can see here, let me use this. This acts resemble the return, and this resemble the period, the time of redemption. So for example, let's say we have here like 1 year, 2 years, like until like 30 years or above, and we have like here 2%, 3% until like 5% or above. So as you can see here, the return rise as long as the period of redemption is increasing. This is the yield curve that is usual. That's the usual yield curve. As long as we go more for the period of redemption, the return should be bigger. So the yield curve as shown in this diagram is a way of illustrating the different rate of return that can be obtained in the market for similar debt instrument with different maturity dates. Although yield curves can assume a range of different shapes, in normal market circumstance, the yield curve is described as positive. This means it slopes upward, as in the diagram. The rationale for this is that the longer an investor is going to tie up capital, the higher the rate of interest. They will demand to compensate themselves for the greater risk and opportunity cost on the capital they have invested. So if you also speak about the default risk, credit risk refers to the general risk that counterparts may not be honor their obligation. A subset of credit risk is a default risk, which occur when a debtor has not met their legal obligation, either that it has not made a scheduled payment or has violated a loan covenant. So investors in bonds face the risk of the issuer defaulting on their payment obligation. Default risk can be assessed by reference to the independent credit rating agencies such as the Standard & Poor, S&P, Moody's, of course, and Fitch rating. These rating agencies assign ratings to many bonds when they are issued and monitor developments during the bond's lifetime. The table will show you the credit rating available from these three companies. So we have here the Moody's, S&P, and Fitch. This is the investment grades, the credit risk. The highest, of course, this is a high or very strong credit credibility. So the credit risk is low, and at the low here will be the very high credit risk. We start with the AAA in the Fitch and Standard & Poor, and also Moody's. They are all the same. AAA, AA, then A, and then we have the medium grade, which is triple B in Fitch and S&P. The Moody's have it BAA, and of course we have this double B in lower medium risk, and also we call it B and A in Moody's. The low grade they all call B, and also we have triple C, which is poor quality, and this may default. And CAA by Moody's. We have double C's in S&P and Fitch, which equal to C in Moody's, which is most speculative. And of course, we have C and C in Moody's and Fitch, and we have D, the same from S&P. This is no interest being paid or bankruptcy pension failed. We have also D from Fitch and S&P, and we call to C from Moody's, which is in a default. So you can see here above this B, this is a very low risk, and below is a very high risk. Of course, with a high risk come high return. So as you can see from the table, bonds issued subject to credit rating can be divided into two categories. This is according to investment grade rating, and this categorized as non-investment grade or speculative. The latter are also known as high yield or junk bonds. Investment grade issues offer the greatest liquidity and certainty of repayment. Note that these terms are not actually used by the agencies, but inferred by industry practice. So bonds rated in the triple B category or higher are considered to be investment grade. S&P and Fitch rating refine the rating by adding a plus or minus sign to show relative standing within a category, while Moody's does the same by adding 1, 2, or 3. Very few organizations, except for the supernatural agencies and some Western government, are rewarded a AAA rating, though the bond issues of most large corporations post a credit rating within the investment grade categories. So now I'm be answering question and going to the live market examples. Let's go now to the your question. Okay, about the Bitcoin. Okay, we have, of course, all-time high. Of course, after the election of President Donald Trump, he is very supportive to the Bitcoin. He made a lot of promises, and that's why we have this 91,000, or even it's more. I think yesterday went even more. Maybe the highest in our chart here is around 93,390. Of course, it's becoming more valuable, but still it's a risk. I don't recommend someone who doesn't know about the Bitcoin, who is not into this kind of digital assets. We already have some webinars speaking about this. So before you invest in this digital assets like Bitcoin, don't just jump to it. You have to understand, you have to know the risk involved, and of course, you always don't trade or speculate with money you cannot afford to lose, and always use this diversity principle to diversify your wallet. We already spoke about this in a past webinar. You can see this in our website. So for me, if you are not into this kind of digital assets, learn more before you invest real money. If you are already there, you can have some amount of your wallet invested in the digital asset, just like Bitcoin or any other trusted. Of course, Bitcoin is the most liquid market in the digital assets. So you can do this as long as you know what you are doing, and this applies to anything or any asset you buy. Gold is not different, actually. If you are going to this now, we are seeing, as you can see here, a very strong move to the down from the all-time high we had before the 2,790 before the election. So it was like we was like around 2,800. This was a very high price for gold. So now we are reaching to the 2,563 at the moment of this webinar right now. Our expectation is we are having very strong dollar right now. We are having a market, feeling more safe and more positive after the election of Trump. So that's why we are having this down move for the gold, because gold is regarded as a safe haven. So when markets actually feel secure, they don't buy gold, they actually go to other markets. So maybe that's why we are having this. I think we are still in the downtrend. It's very dangerous to buy gold right now. I think the daily chart is very clear, it's down move, but also you need to stand in a very safe position before you buy or sell. Of course, you will have the risk management and money management, but I think below this support area, let's see, it was around here. Yeah, below this 2,600, this would be my resistance. My stop loss would be around this area. It's $40 from now. It's very far, I know. So maybe I would wait for some consolidation to other upside to sell around the 2,600 or even 2,618, yesterday's high. So maybe I will wait for this consolidation before I sell again. So I really enjoyed this webinar with you. I hope you find some insights and that you found some valuable information. If there is no more question, I will be ending this webinar. Actually, maybe this will be our last webinar for this kind. We will be doing something else. We will announce this soon, but I will just give you a hint. It will be like a complete course available for anyone from total beginner to advanced trader, and this will be something available all the time for you to enroll. Other than the webinars we have, also we will be having some seminars. We will have seminar in Dubai and at our 7th of December. Also, we might be having seminars in. We already had in Qatar last week, and we are going also to Saudi Arabia next week. Everything will be announced on our website and our social media platforms. So please follow us, and you'll receive an email after this webinar with all my information. You can send me an email or WhatsApp message. I'll be more than happy to answer all your questions. If there's no more question, I think that will be it. So I'll be now ending this webinar. Thank you for your time and goodbye.